With open enrollment coming up, we'll talk about how we approach the seasons of the year.
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks everybody for listening and watching.
Great to be here as well. So one of the things that comes up with financial advisors a lot in the fall is looking at open enrollment, helping clients be prepared for just the benefits that provided through work. One of the direct things that financial advisors look at is like what group life insurance is available to them, because if they've changed jobs or the company has changed providers, do we need to get life insurance outside of it? So it's one of the specific reasons why financial advisors are really curious about your open enrollment. Health insurance matters, FSA, HSA matters. Like there's a lot of things that matter, but there's usually something specific. It's also a reminder for financial advisors that this is a fall thing. Like we don't have to worry about open enrollment and life insurance as much in April. We have other things to worry about. So we want to talk about, we'll start with open enrollment, but more talk about like the seasonality and not just financial stuff, but other things that we think of that fill in the year, because this stuff also comes up in life planning a lot of, you don't go on vacation every single day, but when do you go on vacation? How do you approach the different seasons? And you create this anticipation. And if you have like a good rhythm to your year, there's always something to look forward to. So today we're going to be a little more technical of like, here's the specific stuff that we try to take care of as financial planners, and add in some of the fun stuff that we look forward to each season. So we're going to start in the fall with open enrollment. But Trishul, either getting straight into it, or is there anything else that you want to make sure when the fall is coming up, what do you think about both for your clients and for yourself?
Well, as a Floridian, fall is hurricane season, just coming off of summer. And it's back to school time. Maybe that's more apropos for a lot more of our listeners. So the other big thing is almost always I'm ending up filing for extensions of my tax returns. And this is quite common for a lot of my clients. It's just the nature of how these things go. And the extension returns for businesses and personal returns are due, in September, October.
I think it's October 15th, right?
For the personal returns, and then business returns September 15th. Yeah.
Got it. Okay. The CPAs I know, they now, if they aren't doing extensions for every client, it's pretty close, because it removes the deadline aspect for their own work. They can take a little more time, spread out their workload to do a little bit better job. So I think the last few years, our tax return has been filed in June-ish, as we collect information. But yeah, that idea of the second tax return deadline also starts to come into play.
Yeah, but for those people who aren't ahead of the curve, you're probably doing it sometime after the official filing time of April 15th.
There's also a few things like K1s often, I'll say often, but a decent amount of time come in after April 15th. So you don't even have the information to file your tax return by April 15th. So you have to file an extension to be able to get the information before you finalize your tax return. So that's a good one. Adding the second tax return deadline.
Yeah, and just a little nuance there. A lot of my clients tend to be small business owners, and what that means is they might have something like a solo 401k for their own business, and with that, you want to make sure that you contribute, but you won't know how much you can contribute because you won't know the profit for the business. and those employee contributions end up on the personal return. So there's this dance back and forth between the two to get everything right. And you kind of need a bunch of stuff to line up. And typically it ends up taking more time than you could reasonably get done, by the standard tax filing deadline for businesses and personal returns.
That is a good point of you need to know like what your business expenses were and your revenue before you can even make that the solo 401k contribution up to the business limit. That's a good point.
Yeah.
Okay. For open enrollment, again, I mentioned the life insurance. That really is a real thing. I use that as a catalyst for double checking all of my clients' life insurance and having that conversation. Because again, jobs change, coverage needs change as either I'm going to say I've had to make a change for at least one client each year. One client got a new house, so they have a bigger mortgage, so they need more life insurance. Another client had a child born, so their need changed there. Another client changed jobs, and so the amount of group insurance available to them changed. Sometimes goes up, sometimes goes down. But planning that out, just using that time to take a look, hey, is there enough group term life insurance available to you? And if not, what do we need to do next? So do you have any specific things that you look for with open enrollment?
Yeah. I do want to hitch on one point you made, that it doesn't apply to all clients all the time. And one thing you're going to hear in this conversation is just a lot of things that we're going to be doing, but certainly it's not something that every client needs to do all throughout the year. So the way I try to phrase it to my clients, just so they don't feel overwhelmed, is that I break it down into 2 tiers. The first tier, I like to call it our checkups, kind of like you go to a dentist twice a year. So I try to have checkups with my clients 2 to 4 times a year, maybe once a quarter or every 6 months, depending on individual client needs. And then for this type of stuff that we're going to be talking about, where you have these seasonal things that come up year after year, I like to call them check-ins. So what I like to do with my clients is I'll just send an email once a month throughout the year. And in any given month, just read the email, give it a quick glance. And if it rings a bell, like, oh yeah, it's open enrollment and something did change, then yeah, let's talk about it. But 9 times out of 10, it probably won't apply to you for most months, or maybe only 1 or 2 things out of the entire year may apply to you. So it's just making sure that something doesn't fester, too long before it gets attention. So that's kind of how I like to frame it. It's something that, you'll probably get some sort of correspondence once a month, something like that. But it doesn't mean you have to be on top of things every single month, for this to work out. Just if you get the email, you do a quick scan, and it does highlight something that might be of importance, okay, let's dig into it. So
that might be maybe the difference between your clients and my clients. Maybe just like the age, like a lot of my clients are parents with kids, and so maybe the age of the kids matters, maybe their workload matters, but maybe it's just my personality. You know what? This is probably a huge self-selection bias idea, that I hate homework. So I might attract clients who also hate homework.
Right.
Because the vast majority of the time we do that work in the meeting.
Yeah.
And it's like, okay, I might ask from our last meeting, did you get this thing done?
Yeah.
Like, no, we were too busy, didn't get around to it. It's like, okay, we're gonna take care of it right now.
Right.
So I do think that I probably, again, I meet with almost all my clients about quarterly.
Yeah.
First half of the meeting is kind of what happened over the last month or two that you want to talk to me about, you want to make sure that I'm aware of, changes, things that you've been thinking about for your future. Second half of the meeting is like, okay, here are the bullet points on my checklist that we need to double check, that we need to go through and actually get done.
That's probably similar. So what I have for each of my clients is a running checklist. It's basically in an email, so we both know what it is,
Yep.
and the stuff that they're supposed to do, I highlight in red, and the stuff I do, I push them forward as best I can as well. But obviously, if a client shows up and they haven't done anything, we'll do our best to make progress, on the fly in the meeting. I'm not gonna have them go to detention or
Okay, so
some other
I got a little
reprimand.
bit of story, complete
Yep.
tangent. I'm like perfect 90 degrees related way over here.
Mhm.
I had a conversation with prospective clients, and it comes up a decent amount. Well, they'll ask if I do project work. Can they hire me to do like 1 month's of work on like a project basis?
Hmm.
And I have tried doing this in the past,
Hmm.
where I put together a full comprehensive financial plan. Here's the executive summary. Here's the things you need to take care of.
Yeah.
And sometimes they come back a few years later. Sometimes they just, I don't hear from them again. But the ones who come back, they might have done the first 2 things and nothing else. Because so many people who are looking for a financial advisor,
Yeah.
they get to a point like they realize, oh, we've been meaning to do this thing. Sometimes they got some cash from something that they've been meaning to invest. They have been meaning to refinance it. They've been meaning to look at their life insurance, meaning to update their trust, and like, hey, how much life insurance do we actually need? Like, they've been meaning to do something.
Yeah.
But it's not urgent. It doesn't have to be done that month.
Right.
A life is busy, and they look up, it's like, oh, it's been 3 years. We've been meaning to do this thing for 3 years.
Yeah. Yeah.
Maybe we should find someone to help to make sure it gets done.
Right.
And same thing when it comes with financial planning. Here
Yeah.
are the checklists. You go down this list, you're going to be just fine.
Yeah.
Increase your 401k savings to this, save this much into a 529 plan, build up this cash reserve, make sure that you have this much life insurance for each spouse, maybe look at refinancing more. Like, there's a checklist of things. Okay.
Yeah.
That's like, I don't say generic, but like common financial planning before we get into things like small business owners setting up a retirement plan, ISO exercise for tech employees. And again, they'll do like 1 or 2 things, and then life gets in the way. And so now the reason why I don't do those project basis is when I have that checklist of stuff for clients, I put the big long checklist at the bottom of the email. The top of the email is like, you need to do this one thing. One thing.
Right.
And there's a chance they'll have it done by our next meeting. If it's just one thing. If they say 3, it's still gonna be one thing.
Yeah.
And that's a lot of what the really successful work with a financial planner is. It's not making up the big checklist, which is important. Like, there's a lot of like math and calculations and projections involved. We like figuring out those numbers, but it's having someone that you have a relationship with that is just going to kind of hold you accountable. Like, hey, did you do item number 1 on the checklist? No, that's okay. I understand life's busy. Let's go ahead and take care of it right now. And at the end of the meeting, we have that part done. And we're going to move on to item number 2 on the checklist. And what happens is, instead of that, oh, we should do this thing, and now it's been 3 years, and like, we never got around to it. It's, you do this thing, and 3 years later, you've compounded 12 things that you have accomplished, and you're in so much better shape just by having that accountability partner of like, one thing at a time, one thing at a time, one thing at a time, one thing at a time. And having the conversations with a trusted advisor help you kind of develop the priorities. It's someone comes in like, you need life insurance. More like, doesn't have to be with me. I'm a family financial planner. Doesn't have to be with me. You need like another $1.5 million, $2 million in life insurance that your employer does not provide. This is like item number 1. Other things that might come up that I might just like, you have like 5 years worth of expenses in cash.
Yeah.
I in my mind, I hope that hasn't been sitting there for too many years. I wish it had been invested, but I don't understand that to clients because I want them to feel kind of that I'm supporting them and like I don't want them to feel bad about past mistakes because there's nothing we
Right.
do to change that. But our actions can moving forward, let's get that invested and start working for you. Like
Yeah.
there's usually those little things. So that's the tangent of why I no longer do project-based financial planning. And I do like keep that checklist so the clients are aware.
Yeah.
But my emails have, here's the one thing that I need you to do.
This is interesting because we haven't actually talked about this aspect of how we run our business, but it's very interesting that you and I have evolved towards this type of framework independently without actually discussing the specifics. So I also don't do project based work
Okay.
anymore for very similar reasons. And when I speak with clients, I initially, for example, just to get them up to speed on how this is going to operate, I try to emphasize this is really more about maintenance, right, than some big initiative and then we're done.
Mm-hmm.
And I also like to show, you may have seen this graphic from Carl Richards, another planner who has, these simple graphics to explain, how planning might work. Basically, he has a flow chart with just one box on it. And the arrow that comes out of the box is just saying, do the most simplest thing first.
Yeah.
And then repeat, right?
It's what's the next one step forward.
Right, exactly, yeah. And the analogy or the little story I put forward to my clients is, I remember this has happened many times coming into different businesses that I worked for as an employee. I've come in as like a manager, and very often there's a million things that need to get done yesterday, right? And the notion is there's no way you can do all of that at once, right? So it's always just a matter of, all right, let's just figure out what's the most important thing to do. Mm-hmm. Let's do that. And let's do the next thing. And let's do the next thing. And then over time, it all starts to come together. It really does, even though it seems overwhelming at first. So it's really about just picking things off, and over time you'll get there. And what you just mentioned, even about the task list, the way I kind of break it down is, I mentioned I have these 6 month checkups, and the goal for each 6 month iteration is, let's get something across the finish line that's tangible, right?
Yeah.
So for a given checkup, I say, here are the action items for the checkup, right? for the next few months. And then the bigger list is below, where don't worry about it. We're just putting it there so it doesn't get lost, but focus on this and we're good.
I have so many little stories. Like one of my clients, she had an old 401k, is pretty sizable. And like, okay, let's make sure that's invested correctly. Well, again, mostly equities. I think she had some bonds, but based on her age, we want to be more aggressive. And let's make sure the beneficiaries are your spouse and kids. Like that's so easy to do. Takes 5 to 10 minutes in our meeting. Yeah. Okay, next, let's try and schedule a call. We'll call the 401k company and we'll roll that over to an IRA. Okay. Like, okay, that call, like, looking at a schedule, like maybe next month. Okay, that meeting, like we had to push that back. It stayed there for 2 years. But because we had spent the 10 minutes at the beginning, it was invested fine, it had the correct beneficiaries. It was just fine. It took us 2 years to roll that over, but she was just fine. Like, so that's the prioritization of even like this 401k, what needs to get done now and what can wait.
Yeah.
Because we would talk every quarter, like, hey, do you have time for that one thing? It's like, nah, I don't have the energy. I don't have the mental space. I don't have can I ignore it? Yeah, actually, you can ignore it. It'll be just fine. It's invested well, grew a lot over those 2 years. And those little things come up all the time. Another client, we were doing 401k stuff or 403b stuff for this particular client, and he changed jobs. So it's like, okay, Now we got to start that 403B process over again. It's just going to, and do you have any clients with 403Bs right now?
No, TSPs, stuff like that.
Okay.
Yeah.
403Bs are notoriously difficult.
Mhm.
And it's one of like the districts try to provide lots of choices.
Yeah.
And ends up being like you have to coordinate with the district third-party administrator, the TPA, and the
Yeah,
custodian that you want.
that's right. I do have a client who had that. Yeah.
And I remember I had actually my mom. This would be 15 years ago.
Yeah.
We had to get her wet signature sent to the TPA to get their wet signature, to get sent to the custodian to get their wet signature, back
Yeah.
to the TPA to get in the wet signature.
Yeah.
It failed 3 times.
Uh,
It took us like 2 years to like.
This is such unnecessary bureaucracy.
Correct.
You know.
Correct. So 403Bs are notoriously difficult, and it's like clients start a new job. Like, okay, we're gonna try this. Nope, didn't work. It's okay. We're meeting again next month. We're gonna try it again. And I have on my checklist. We'll hope it's in place now when he gets his
Yeah.
next pay stub. Because again, teachers get paid once a month, so you don't like
Yeah.
find out if it worked for a month.
Oh no.
But that's what real financial planning feels like sometimes.
Yeah.
It's just
Yeah.
it is so frustrating to the individuals having to deal with this along with all the other stuff.
Mm.
And just having someone say, "Hey, you can ignore that. It's
Yeah.
it's good enough. Ignore it." Whereas this other thing, we can't ignore. We need to fix this now. And that
Yeah.
like being able to not have to think about all the stuff and only focus on one thing. I found it's like energizing for clients. It feels good, like you said, getting that thing across the finish line. This is why like set and forget it strategies work so well.
Yeah.
That again, if you forget it for 2 years and you're in a better place, awesome. Let's do that.
Yeah.
We'll clean it up later.
And the vision is you can literally turn your financial life into like a well-oiled machine where things are just working. They're doing what they're supposed to
Yes.
do.
Yes.
Money's coming in, things are getting paid, investments are growing, and you're taking care of, whatever needs to be done. Once things are set up and, the gears are running up, firing on all. I'm not a mechanic. The cylinders are firing in all gears. How does that go?
Firing on all cylinders.
Yeah, right.
So do you want to do you know how an engine works?
No, I kind of get it, but what's firing on all cylinders?
It's an engine. It's you could have like a 6-cylinder engine, but sometimes they'll turn 2 cylinders off, and the
Right.
spark plugs and the timer get the timing. So you have 4 pistons going in sync. So as the pistons go up, they're turning. I think it's called a crankshaft.
Right.
And so if you can get 6 pistons all going, it's like it's called a V6. But
Yeah.
the timing of those V6 matters. But you can get the crankshaft moving faster and harder.
Yeah.
Uh,
So I guess the spark plugs are firing on all cylinders. That's what it would be, right?
You wouldn't say spark plugs. Like just we're firing on all cylinders.
But what's firing?
So the piston,
the
the piston opens up gasoline. It's I forget the device that puts gasoline inside the piston, so it takes from the tank, but it's in
the fuel injector.
Aerosol fuel injector. Thank you. But it's
There
going to
you
be more of a like aerosol mist kind of. It's not liquid gasoline.
Yeah.
Sorry, and the piston compresses, spark plug sparks it, and explodes.
Yeah.
So it's internal combustion. That's the actual combustion. So that it explodes and pushes the piston down, and you do that a little bit at a time. Each piston, hundreds of times a second, kind of thing.
I'm comfortable saying it's the spark plugs that are firing because isn't that what's technically creating the
yes
actual explosion?
But I think the expression is that we're firing on all cylinders, instead of most of our cylinders or part of our cylinders.
Yeah, all right. So the notion that the other thing I wanted to highlight is maintenance is important. Like, for example, Aaron, I've mentioned this a few times. I've come a long way with my own physical health and doing a lot of activity to make sure that I have some sort of routine. And, to keep my financial health in line, it takes, like I said, like a few minutes every a month or so. And then 2 check-ins a year is well enough for most clients. But, for my physical health, that's 5 days a week. An hour commitment. So I can't imagine. I think for some people, yes, that they have the financial anxiety of, not wanting to deal with, the finance aspect of their lives too often. But I'd say the amount of commitment it takes is probably far less than you would devote to your physical health.
So I've heard other financial advisors kind of describe them, if they had to like oversimplify, they're like 1/3 accountant, 1/3 personal trainer, 1/3 therapist.
Okay.
Super website. This is the first time I've thought about like trying to add mechanic into that, because I actually really like that. Where once we get a finely tuned machine, a well-oiled machine running, things will still break. And changes in life happen. And having that mechanic to fix the thing, and like, hey, if you're able to drive to the mechanic and something else, that's different than if you can't drive to the mechanic, you need a tow truck. Like, there's different levels of urgency.
Right. Yeah.
And if you had a mechanic doing a tune-up every quarter, then less likely we need to have those tow truck issues.
Right.
And more likely that like we're just gonna have a small fix that we can do in that regular tune-up. So like getting the oil changed, which is super stuff, like electric cars are like getting rid of oil changes, like maintenance is less frequent. I'm starting to look at electric cars. I have no idea like what that means, but
brake pads. They need more brake pads.
Okay. So, but having that tune-up idea where the mechanic's first job is just like get the car back on the road. That's item number one. Then like, okay, hey, you should probably replace your tires sometime in the next 6 months. We should probably your brake pads are fine for now, but they'll be to replace sometime in the next year. You gotta get regular oil changes. You need gas a lot more frequently. You need the correct gas for your car.
The right octane,
Right, yeah. So I'm gonna try and figure out how, because also like if the mechanic's doing a lot of the hard work up front to get the car back on the road, you can kind of see the like tapering off of time and energy from the mechanic's perspective, where sometimes it does get easier, but if your car breaks down, you already know who you're taking the car to, and because if they know the history of your car, that's another like that personal relationship aspect, they can either check the other things that might have been an issue, or they know, hey, these particular cars are known for this issue. I already have a replacement part ready. So I want to try and think of how can I incorporate mechanic into that, like accountant, personal trainer, and therapist analogy.
Well, I think a good percentage of my clients are from the healthcare industry, so I've always used the checkups and check-ins notions. Like, you go to, I mentioned the dentist, but like your PCP, right? It's a lot better if you are proactive, right? And you catch things early and you do your diagnostic tests. What was that?
You said PCP, is that your personal care physician?
Primary care physician.
Primary care physician. Okay.
Yeah. So you just have your annual checkup or your biannual checkup, right? And you get your blood levels checked, once a year, et cetera. You have your physical diagnostics done, and essentially, once you get things in check, then it's like a smooth running machine.
Okay. To get our conversation back on track,
Okay, that was a bit of a detour. No, that was an apropos detour. It wasn't.
Thank you for that. I appreciate it. I think it was relevant and entertaining for us.
Sure.
But it's kind of a giving people an idea, like removing the curtains behind the scenes. Like, here's what advisors actually think about why a lot of planners don't do projects.
Mm-hmm.
Okay. Anything else in the fall that you think of that? Okay. I have.
Yeah, I have
check
my
my
calendar
notes.
daily open up here, so I can just tie into some of those things as I'm in a sea of windows at the moment. All right,
so one of my things for Netflix employees specifically, they have a very unique employee stock option plan.
Yep.
For their SOP, you can choose how much of your income you will defer into at the money non-qualified 10-year options.
Mm-hmm.
And you have to actually do this during an open enrollment period because it actually reduces your W-2 income. So it's a way to reduce W-2 income, and it's different than like a 401k because of the way the plan is set up. And they have to decide in advance what they're doing for the following year.
Mm-hmm.
So I've talked about in the past how this is probably the riskiest employee benefit I've ever seen. Now, Netflix stock has done very well, so they have benefited from the high reward aspect of that high risk.
Mm-hmm.
But having a conversation of, yeah, this money, you have to be prepared. You could lose this. Like it's a realistic possibility if the stock price goes down in the next 10 years or stays flat, you never gain anything.
Yeah.
So how much of your income do you want to defer? Again, it saves you on taxes, high risk, high reward. Having that conversation, I don't want to let it just kind of happen automatically. It's not like a 401k where, hey, we did this much last year, let's do this, just max it out last year, max it out this year.
Yeah.
We want to actually have a savings conversation about it where, yeah, when you did this at 600 and the stock in 2021 and the stock price went down to 200 in 2022, yes, you benefited a lot. Now the stock's over 1200. There's risk there, and we make sure that you understand that. So that's one of the things that I see specifically. What about you?
Yeah, so fall is also a time where there's some end of the year deadlines to think about. So if you're going to be doing Roth conversions, you want to make sure those are geared up. If you're going to be doing some tax loss harvesting, you want to make sure you're on the right side of those trades. And the other thing is sometimes clients come in with a large set of legacy positions that we want to over time kind of neutralize to a diversified portfolio. You know, if they're highly concentrated in a few different stocks, we know that it might be too much to do all at once. You'll just get too massive of a tax bill, you know, in any given year. So we might say, okay, let's break this up into a couple years. And around Q4, you have some notion of what your overall and yearly income is going to be. And then you have some notion of the delta before you bump into like the next tax bracket on how much you could potentially sell off and take the gain on, so that, you know, you can be prepared to have those trades in place before December 31st.
I like that idea. So kind of transitioning from fall to end of year. So I think that's financial advisors don't think of fall and winter. We think fall, December, and January, because so much of the tax stuff is calendar year based. There's a big difference between December 31st and January 1st. So
I call it Q4 because that's the deadline.
Yes, but I think of October, November, which are part of Q4, as a different season than December, because it's distinctly different work. The open enrollment stuff is different thought processes from December. So it's almost like you got a September, October, November season. So there's usually just October, November, because that's when the vast majority of open enrollment periods are, and a December season.
So that I do want to hit you on that, because actually I found that December is not the ideal time to make new decisions. So what we ended up doing is we come up with a game plan by November, and then all else being equal, we'll execute. Yeah, we might execute in December.
Okay, that's
But
true.
yeah,
I think that's a good point. We probably talked out the strategy in advance,
right. Like we
but
know what to do, and then we'll pull
yeah,
the trigger in December.
first 2 weeks of December, we need to do some math.
Yeah,
For those with incentive stock options, ISOs, especially at private companies, we'll probably look at your income for the year and
right.
what your AMT is projected to be. So we might be able to do ISO exercise without going into AMT.
Mm-hmm.
So there's a spread number there. But again, we have to have a good idea what your income for the year is. And we need a
Right.
CPA to do the math on both your taxable income and the AMT so we can project that ISO exercise. Again, private company most common because we can't sell any shares to either increase our regular taxes or provide the cash for that. So more common private companies. That you mentioned the marginal tax bracket for some of my retired clients doing
Yeah.
Roth conversions, especially if they are retired but not
Yep.
collecting Social Security.
Right.
We want to
Exactly.
get make sure that your income's getting close to that 60K single, kind of maxing out that 10% tax bracket
Yeah.
each year. We don't want to see a 0-year tax because we can shift income from your pre-tax IRAs to your Roth IRA at a 10% marginal rate. That's going to save you down the road when Social Security starts coming in and RMDs start kicking in. So
Yeah. That's also a big one though. RMD deadline December 31st.
yeah. So I don't think I have any clients at age 75. I don't think I have any RMD clients yet.
I do, and so there's two ways we kind of go about it. One is if a client is relying on that RMD amount for like their income to supplement their lifestyle, then typically they just get a monthly paycheck from their RMD account. We set it up so that it's like they have an income coming every
Yeah.
month. And typically we do the math so that you satisfy the RMD by December. But there's some situations where the client just doesn't need those funds, even though they're forced to take it out, and in which case we might do it more as a lump sum.
Okay.
Yeah.
Okay. I think that actually kind of goes into our next thing. Like you mentioned, next season was for me is basically January, like maybe January, February. But it's now what is stuff we want to do early in the year.
Yeah.
Similar to what you talked about, how you try to set up those RMDs at the beginning of the year if they're taken out systematically. You can actually, once you know the 1231 value and you know their age, you can tell them what their RMD is going to be for that year, and you take it out monthly. So for those,
Exactly. Yep.
similarly for clients still working, we look at their 401k contributions. If we want to max it out, it probably has gone up. We don't know the number is going to be yet, but we're guessing in 2026 it's going to be 24,000 or 24,500. 2025 the limit was 23,500. So we want to make sure that we get that little tiny bump. If they've gotten a raise, they may not need to do anything, but sometimes we just want to bump it up 1% to make sure we max out their 401k for the year. And it's a lot easier if we do that in January and they don't even notice the difference on their take-home pay than trying to do like an extra big contribution later in the year.
Yeah.
So that's one of the first January things that I do is checking their 401k contributions.
Yeah. So we're talking about first quarter now, and the big things are essentially contributions, right? So your 401k, also your IRA contributions in Q1. So I've kind of two classes of clients. One class of clients, they want to be ahead of the curve and they want to get their IRA contributions, close to January. That's me too. Just for, it's a new year. So just get the money to work sooner rather than later. If you're going to do it anyway. And so, we would work through the clients to make sure that crosses the finish line. And then there's some clients who, they're on the other end where they have until April 15th to do last year's.
Their prior year contribution. Yeah.
Prior year contributions, which is fine too. But yeah, if the goal there is to also get those before April 15th, then Q1 is when we typically get those across the finish line.
I can also see if they're close to that Roth contribution limit, can they make a Roth contribution, or do you have to do a backdoor Roth? I can kind of see that, where we don't want to leave money in after-tax IRA. I guess if you're just going to create work for yourself, you could do the all backdoor, that'd be fine.
Yeah, that's kind of what I've learned over the years, because if you're going to be close, let's take the anxiety away. I'll just do the backdoor Roth.
Yeah.
Let's get over with, move on. And it allows you to get that money invested in January of the previous year, so you get 1 extra year of compounding.
Yeah. Yeah. So I just see the same. Like when you said you had 2 flavors clients, I knew exactly what you're talking about. It's like those who want to make the contribution as soon as possible, or those like it's always a prior year contribution. Every year, it's a prior year contribution. So I really do understand that. I would say, since more companies have added the mega backdoor Roth 401ks, I see this happening less. That for those who are capable of saving more than the 401k limit, they're more and more common. The employer allows them to save even more than the Roth IRA. And so it's like, it comes to a situation where, yes, you could max out your Roth 401k, then max out your after-tax 401k with Roth in-plan conversions.
Right.
And then on top of that, max out a backdoor Roth IRA.
Yeah.
But now you're saving like $77,000 a year. And you know what? If you just saved $70,000 that year, you're probably going to be fine. So it ends up happening, and not everyone's maxing out the mega backdoor Roth, but I have needed to do fewer and fewer backdoor prior year contributions for Roth IRAs, just as the ability to save into 401ks gets bigger and bigger, and we might be saving the taxable accounts for other lifestyle stuff.
Right.
They want to buy a house, they want to fund an ADU, they just spend more on vacation, et cetera, et cetera.
Yeah. So just a quick recap on some of those numbers. So essentially, if you have a 401k plan, or the 403b, or the TSP, or whatever employer sponsored plan you're talking about, these are defined contribution plans, and the limit is for 2025 $70,000, right?
Yep.
But most employers don't end up having their employees reach that limit based upon standard employee contributions and employer contributions. On the employee side, an employee can contribute $23,500 for 2025, and an employer can do some sort of match. But you add all that up, you most often don't get to the $70,000. And the mega backdoor Roth allows you to get that full $70,000 once you add everything up together.
Yeah.
Right. So
and then for those over 50, you have catch-up contributions, but actually it still stays under that 70. So like even with catch-up contributions, you have to stay under the 70. You know what? Does that sound right?
I think it is.
Yeah. Catch-up contributions don't allow you to go to like 77.
Yeah. So the catch-up contributions are, if you're above 50, it's 7,500. And if you're age 60 to 63, it's 11,250.
Okay.
And 403b has its own catch-up contribution if you have 15 years of service, just because let's make things even more complicated. Tax code's already 1,000 pages. What's 1,000 or 10,000 pages? What's 10,001? It's an additional 3,000 catch-up for 403b if you have 15 years of service. So anyway, so you have 70,000 on the defined contribution side. Plus, if you can squeeze in the mega backdoor Roth, then you could add another 7,000 or 8,000 if you're above 50.
Yeah.
But double that if you have 2 spouses, then you're talking about
that's also pretty common, where it is easier. Like if one spouse has a mega backdoor Roth and the other doesn't, instead of like the second spouse doing a mega backdoor or doing a backdoor Roth IRA, the first spouse just increases their mega backdoor Roth by $7,000.
Yeah,
as long as we're targeting
you don't max it out. Yeah.
So again, this is where like savings rate matters. Like depending on your income, I want to do a quick. if we had in that situation, we need 70 plus 24 at a 15% savings rate. They need an income of like 630. So it is unusual. Most of my clients, their household incomes below 500. If they're saving 20%, there's like 100K. So I guess maybe we get close. Like maybe they're only saving 18 or 19% for retirement specifically.
Yeah.
The last couple of percent can go into a taxable account.
Again, there may be a subtle difference again between your self-selected clients and mine.
I picked that based on like just an easy number. I was also trying I was trying to think of a situation that I do have where the mega backdoor Roth was not sufficient.
Yeah.
And I do have a couple clients, but in those situations, we're actually still not doing the backdoor Roth IRA. We're saving in taxable accounts for other reasons.
Right.
So that's why I say if mega backdoor Roth 401k is available, it is unlikely we're doing backdoor Roth IRA contributions.
Yeah. So again, a little bit of the distinction we might see between our respective client bases is I'm comfortable with a client moving forward with 20, 30, 35% savings rate.
That's true. That's true.
Meaning we would be, really maxing out all these things and getting as much as possible out of these tax shelters.
Okay, so I don't think it's worth. Okay, it's the clients whose incomes are higher than that usually start to have RSU income.
Yeah,
and that's a different conversation. It's okay. Okay, like how do we account for RSU income versus the asset is a too individualized planning for a side note in our seasonality podcast episode.
We can put a post-it note on that one.
Okay.
Where are we? Q2?
No. I had one other thing for beginning of the year. So I mentioned we do the ISO exercise for end of the year in private companies. In public companies, we actually tend to prefer ISO exercise at the beginning of the year. This does a few things. The first year, it's not as much, but there's usually the first year some kind of IPO date. So like there's different timings. But if you have ISOs that you have not yet exercised, the company has gone public, and whether it's due to AMT, exercise cost, or just like you're just waiting on these to see what happens, exercise at the beginning of the year allows you to start your 12-month clock so that they become long-term at the beginning of the year next year. So estimated payments aside, that's a different conversation, again, individualized. Theoretically, you could exercise ISOs. If you owe AMT or any taxes based on that exercise, you can sell them the following year before your tax bill is due. So you can get long-term capital gains, get preferential tax rates, generate the cash to cover its own tax bill. Because with ISOs, there's no withholding requirements. Again, estimated payments aside, then that's an underpayment penalty is a different issue. But ISOs, there's no withholding requirements on the ISO exercise the way there are for NSOs. So it makes sense to exercise at the beginning of the year so that you go full cycle and you're still beginning of the year before you owe the taxes. It also tends to create the cash that you can use to exercise the ISOs for the next year.
Right. And so it's like a ladder.
Yeah, you start to get into the cycle of how often you're exercising ISOs each year. For most people, that cycle only lasts 2 or 3 years. It is unlikely that they've had a lot of unexercised ISOs, the company's gone public, and they still have a lot of unexercised ISOs for multiple years. It is more common with some combination of exercise and sale to both provide liquidity, like take advantage of the actual IPO. It builds up the regular income, allows us to exercise more ISOs without going into AMT. It starts to get complex, but it's unlikely that we go on this kind of cycle longer than 1 to 3 years. But it's the same idea of we are more likely to look for unexercised ISOs at the beginning of the year, especially January, than we are April. Like it would be really annoying to like get an AMT bill that you have to pay by April 15th, but you can't sell the shares until a trading window on like April 30th.
Right.
And that brings up the other thing. Trading windows also apply. So even if you exercised in January, so exercise usually is not subject to blackout periods. Selling shares is. So you want to make sure that you both have gotten long term and you have a trading window before your April 15th deadline.
Right.
And so it's common if there's a Q4 earnings call for a company will be in the middle of February, and so the trading window will be like February 15th to March 1st. That's 2 weeks, like a small trading window, but that's a possibility. You want to make sure that your ISOs have been exercised for 1 full year before we get to that trading window again.
Yeah.
And a lot of times if the IPO happened 1 year in the middle of the year, you don't exactly know when the earnings call cycle is. You also might start to get to like RSU vesting, where if it's a February schedule, and that's pretty common, like February, May, August, November. Again, if you have ISOs that maybe don't vest until February, you want to like vest like exercises so they vest in February, and then they will be again satisfy that cycle, open the trading window, and all before April 15th. So it's like beginning of the year, lots of equity comp planning issues setting up for the following year.
And I can imagine each year your window gets smaller and smaller because you got to wait 1 year.
Yeah, you got a year plus a day. Yeah.
So it's like
and
it's like a
life,
fuse coming towards it.
Kind of. I think I was looking at the clients today. It's like we had a ISO exercise like January 19th of 2024. We didn't have our meeting until like mid 20s in January. So the next ISO exercise was like February 12th of 2025. And like, but that for this particular client was fine because that last one exercised all the remaining ISOs.
Yeah, I was going to say you get lucky because it only has to go on for a few years.
Correct.
Eventually, the music will stop. And
correct. There are some, I'd say, executives that have large ISO grants, but the more common company cycle is the ISOs get granted early on private stage. They will then transition to NSOs as a company like, hey, we think we might be able to go public. And within like a year or two before the IPO, like we know we're going public. It's just a matter of when they'll transition to RSUs. Right. So the company just kind of stops granting ISOs as coming public unless either you're really high or really early. Right. So yeah, that very long-winded, lots of equity comp stuff to do in January.
Right. I hopefully this doesn't overwhelm people too much, but from my perspective with my clients, generally Q4 and Q1 are the busy seasons, out of the four, whereas Q2 and Q3 are the lighter ones.
For me, again, I think it actually has to do with one of just age of kids. Like I'm 42, my kids in high school, middle school, and elementary school. I tend to attract clients who also have kids of similar ages. Summer's really, really hard, but once kids are back in school, like, oh, we meant to do that 3 months ago. Now we have time.
Right.
And so
I think that's it too. Yeah.
Fall tends to be like a lot of client planning meetings. Probably like, again, Christmas, New Year's is really hard. So like the last couple weeks of December and first couple weeks of January, hard to like we do a lot more emails, like very few meetings. A lot of it's like math of like, hey, I did the math, do this, and they can take care of it. But then probably second week of January through April-ish, April, May is decent amount of
Aaron, did
client
I
meetings.
lose your sound?
I don't think so. I can still hear myself. I I need to test my sound.
May need to do some. Well, it looks like we just lost Aaron for a little bit. I think well, let's go on to spring. Just because we're into the hour by a good amount. So spring, I would say, is again just a time to make sure that things got buttoned up for the first quarter. So we're talking about Q2 now for the year. What that typically means is, on my end, make sure those taxes got filed, make sure that whatever contributions needed to be done by April 15th were done for the IRAs. And now it's just time to basically do some sanity checks on the investments. Make sure that things are going okay with the portfolio. If there are any major things coming up, that's fine too. And you can do some lighter things that aren't super high priority, right? Things that can, take some time to run through, but still, give it a touch point once a year. So that's why around this time, may look at like beneficiary designations on accounts, make sure they're what they need to be, double check the estate plan, just do a review if any major things have changed that need to be added to the estate, that weren't previously in there. Maybe you moved or you have new property, vacation home, things like that.
Can you hear me, Trishul?
Yeah, Aaron, you're back.
Okay. So I heard you the entire time. I don't know if you can hear me. But you mentioned the beneficiary designations. That is really important. And when I check the 401k contributions at January to get that like lined up for the year, that's also when I check beneficiaries.
Yep. Yeah. So Aaron, I was basically talking about Q2 now, spring-ish time. Hopefully returns are done and there's some more time to reflect on, less time-sensitive issues, but things that still might need a certain checkpoint every now and then, like once a year.
I do see, I guess for me, helping out CPAs tends to come in play, where it's very time intensive for CPAs and tax preparers. So one of the things that I'll do is I can provide a detailed, organized spreadsheet of stock transactions. So like different equity comp styles, ISOs, NSOs, RSUs. Here are the vesting information. Here's the withholding information. Here's the sale information with short or long-term capital gains and or AMT implications. So because I track that throughout the year, I can usually provide that for the CPAs for a few of my clients who do have pretty complex equity comp issues. So that's it. That's usually one of my big spring things.
Yeah. So hopefully around this time, if you're ahead of the curve, maybe you got your taxes filed, in which case, you're more than welcome to pass them my way, where I would do some preliminary tax planning. I would say the main tax planning does come towards the end of the year when everybody has their extensions. Their returns filed. But
I feel like I do review their tax returns, but most of the tax return work I do find is before April 15th. At the very least, it's a making sure the CPA has done just enough that they've made the payments, because payments are due April 15th, regardless if you file an extension. And that's usually the big concern for clients. It's do I owe a big bill from a big stock sale and we have the cash set aside? How much do we need to actually make the payment, even if we're not actually filing? So cash set aside for tax bills, organization of stock transactions. So I do find that I am not busy, but has that timeline urgency.
So there's a few ways, and it depends on the client and how they're kind of managing this, but there's a few ways to handle the tax bill. So typically, the preferred way is, let's make sure you get your estimated taxes, set up so that you have some notion of where you are. If you're on a W-2, it's already taken out, right, from your paycheck, and you're pretty much mostly okay. unless there's some sort of big tax event. And usually if there is, we know about it, and
Yeah.
we just sell off a bunch of stock, and we might say, okay, well, you're going to have this hit of estimated taxes, so make sure it gets done by the end of this quarter's deadline, right? So hopefully when it does come to tax time, there, in most scenarios, shouldn't be a big surprise, right, in terms of what to expect. And there certainly shouldn't be penalties if you've made those estimated tax payments on time, and you've covered the amount that you need to. The brief rules on that are, maybe I should pull it up before I start spouting it, or Aaron, you can correct me, but essentially it's 90% of the current years or 100% of the previous years, unless you have over 150,000 in income over the previous year, in which case it's 110% of the previous year.
Yes, on the federal side, in the state of California, if the income's over $1 million, including stock sales, you no longer get the 110% of last year's tax. It has to be 90% of this year's tax.
Oh.
So there have been times where we've had to make larger estimated payments on the state side than on the federal side, because there's also conversation of it, depending on where interest rates are, would we rather leave that few $100,000 in cash for 6 months? Right. And what's the estimated underpayment penalty versus the interest that you would make? So there's usually a conversation there. So some clients, they hate paying the tax bill. They would rather get a refund, even if they give up that interest. It's like, that's okay. We can plan around that. Other clients, like, I'll leave this money in cash and earn 4% and pay a big tax bill, no problem.
I was going to say, pay tax on the interest too.
Yeah. So, yeah, that also comes into play. But that's not due until the following year's tax return.
Sure.
So,
right. Okay. So,
do you do anything in the summer?
Yeah, I was gonna say any loose ends, because I think that covers most of it. Again, I think the summer is similar on my end too, even though my demographic of clients isn't exactly the same as yours, where it's just tough to get a bunch of stuff done, right? People like to take vacations.
People take vacations. Kids are out of school. I do have meetings like, I also take vacations and my kids are out of school, but like, I do have meetings throughout the summer, but it's just hard to get people to really pay attention. Like, it's probably, there's no deadlines, there's no urgency, like, kids are home, too many other things to think about. It's easy to just like ignore finances for June, July, August.
Yeah. So, you'll still get like a monthly check-in from me, but it'll just be, just take a second, even read the subject of the email. It has nothing to do with anything you care about, fine. But if
do
it does,
this one thing.
Yeah. Right.
So.
Yep.
Okay. So I thought we'd get more personal, but I enjoyed our tangents a little bit more. So that was a good recap of what September 2025 through August 2026 are going to look like.
All right. Yep. Good stuff, Aaron. Hopefully it wasn't meant to be overwhelming, but just provide some insight on how all this stuff gets managed over the course of a year. And believe me, it's not so bad. Everything can be taken care of in due time without a crazy amount of commitment, right?
Yes.
Hopefully.
You don't need to listen to this podcast a dozen times. If you hire an advisor, they'll tell you the one thing you need to do.
Right. So. Good stuff, Aaron. All right. Well, thanks everybody for listening. And if you enjoyed this conversation, do spread the word. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.